Hello, everybody. How we doing out there? Doc Severson with you here, Trade School here at ReadySetCrypto for Friday, the 2nd of August. I can't believe we've gotten into this month already so far, and it's coming down pretty soon. I'm going to be moving in 3 weeks. This is going to be, oh boy, you can't believe all the little details that come up with a move. Anyway. So there we are. Okay, so today what I want to go over is we're going to continue on the same vein that we've been on for the last couple of weeks, and I want to dovetail this into the income with options class that you guys should all have access to now. And so without further ado, let's get into, I want to make sure this is working here. So let me make sure that we have sound and picture for everything. If anything is not working, please write into the chat window and let me know. And otherwise, I will get started here with today's presentation. And of course, take your questions at the end of this. Not going to be talking about any trades today. So the main topic today is how option values move. How option values move. So, and if I get in the way down there in the lower left-hand corner, let me know and I'll get rid of that. Okay, sound and vision coming through. Okay, so we frame everything within the 4 applications of options, which is what I talked about last week, which was number 1, loss protection or buying long puts. Number 2 was leveraging gains or buying long options, or long calls in this case. The insurance company application, which was selling puts to create income. And then finally, the landlord application, where you're going to be selling calls against an asset that you already own. Okay, so those are the 4 things that we are keeping as sort of our bedrock here so that we can anchor those into applications to use. So my sense is, though, just like talking to some people in the Discord community, as well as some of the questions I've got through email lately, is, can you keep going over like how option prices move? Because I think this is probably the most bewildering, confusing thing, especially. So instead of before, you were just buying low, selling high on the spot currency. All right, everybody gets that. You've been doing that your entire life with things. So now all of a sudden we've got 4 dimensions that we're working in instead of just 1 dimension. So we're not only buying things, but we're also selling them. And now instead of just the long currency, we have calls and we have puts. So it's 4 times more complicated than it was before. But trust me, this is worth it in the end. With a little bit of diligence, a little bit of work, you can quickly get into this. And what I'm going to try to do, or what I'm doing in the program, is trying to like winnow things out. So like, don't worry about this, don't worry about that. Just focus on these things here. Because what I want you guys to be able to do at the end of the day is to be able to sell options for income and do so in a safe and consistent manner. The one aspect of options that takes the longest to figure out is knowing how the price of an option will move depending on the forces applied to it. So not only do we have the 4 different things going on with calls and puts, and we have long and we have short, we also have a bunch of different forces acting on that option as well too. We have price, time, and volatility. So we need to be like that puppeteer. I want you to lock this vision into your mind, this image, in terms of what you're doing, because as an option trader, you're really kind of a puppeteer. You're pulling a lot of different strings, and you got to know what each string does. You got to know that one pull on one string moves their arm, right? You can't just be arbitrarily moving things around in there. So here's a quiz question for you guys. I'll let you chew on this one while because I'm like 30 seconds ahead of what you hear. So I'll pose the question out there and I'll let you respond in the chat window and see what you guys think here. I've just sold a put option to open. So I've sold that put option to open the trade. What do I want to happen from here? From here until expiration. What do I want to happen with price? What do I want to happen with time? And what do I want to happen with implied volatility? Unfortunately, I don't have much control over what happens with time, but is time my friend or is time my enemy in this position? So let me know what you guys think. Just type it into the room, and I'll circle back on this one in a minute. So let's go over the external forces of price time and implied volatility and how they affect an option's price. Let's focus on price first. If this is all that you learn about with options, then you can do okay. But ultimately, you'll want to understand the other dynamics, because otherwise you're going to have these unexplained things that happen to you and you're not going to be happy with it. So let's talk about changes in options value with changes in the underlying price. Okay. Anybody have any other answers to? Yeah. Okay. Getting some good answers in here. Okay. So when we're talking about the underlying price, we're talking about the underlying asset, the spot currency price, which is going to be the spot price of Bitcoin or the spot price of Ethereum. I don't care whether it's listed on Coinbase or Bitfinex, or whether it's, you will find that out. You will know what the spot price is on any exchange or broker that you trade options with. Okay. And I'll come back to that quiz question in just a second. So here's something that I want you guys to sort of understand, and you have to be able to sort of push yourself to get this in the near term, because you'll need to know this on the fly. So let's first of all talk about a call option. And if this is priced from low to higher, so low to higher, if we trade a long call option, that's bullish, and the value increases to the option buyer. Remember, it's always important that we understand from the reference of whom this matters to, that we care about this. So if a call option goes higher in price, if I'm a buyer, I'm happy, but if I'm a seller, I'm not happy. If I'm a seller of a call option, I'm not happy with that, because if I short the call option, if I sell the call option to this guy, he's happy and I'm not. I want the price to go from high to low as a short call holder. So the value increases to the option seller as the price drops. Remember, this cheat sheet is only for the dimension of price. So now if we go over here to the put options, again, the price is higher to lower. If I buy a long put, that's like buying insurance, and I want the price of the underlying to go lower for my long put option to increase in value. Now, if I short the put, if I sell that put option to open, it's a bullish trade, and the value increases to the option seller as the price rises. So these are the four dimensions that you have to understand, whether or not you're trading calls or puts, whether you sell it to open or buy it to open. You need to keep practicing on this with a cheat sheet until you got this down. You know exactly what's going on with these. So let's do this. Let's go back to the quiz question here for a second. And let's talk about this. If I just sold a put option to open, then just based on what we talked about with price, it's a bullish trade, and I want the price to go higher. I want the price to go higher. From a time perspective, I have no control over time. It's going to be linear. It's going to tick off every day, every minute. But all I want is, from a time perspective, time is actually my friend in this case. Remember, there's only a certain amount of time before that option expires down to 0 at expiration date. So if this is the expiration date here, if I sell that option, there's only a limited amount of time that the move can take, right? So time is actually on my side when I sell an option. Now, implied volatility, again, this is going to be a little confusing for you guys, but implied volatility, if I sell an option, I want implied volatility to go down after I enter it. I want to sell it when it's high, because what that's going to do is that's going to increase the fluff, the time value, all the stuff that I'm selling. That balloon is going to go really, really big. And what happens is if I sell that option when the balloon is really big, and then if the balloon comes in, if it dissipates and gets small and wrinkly like that, that's good because the value of that option to the buyer is going to go down. But to me, the seller, I can buy it back for a much cheaper price. Okay, so this is called short Vega. I know that that's way beyond the scope of today. But if we're an option seller, we want to sell high volatility and we want it to collapse after we've sold that. So think about a condition that would happen if we time everything perfectly, where all these things would come into play. And you're going to shortcut to where I'm going to go in one of the later modules of this program. Okay, so let's get back to our cheat sheet. Everybody understand the cheat sheet? Let me know if you can't, or if you're confused on one element of it, and I'll go back to this. So let's say that the current price of underlying Bitcoin chart is 10,500, which I think is pretty close to that right now. It's just above that. Actually, a nice little rally the last 3 days. Let's see what will happen to the options value of long and the short puts and calls as the price goes up and down. So if I have long calls with this, and if the price goes up or down, if I have long calls, then all I care about is this side. I don't care about the puts. The puts are over here. All I care about is the calls. So if we see the price go up, then these values are all going to go higher. All of these values will go higher. Now, some will go make larger gains than others will. And this is the sort of nature that we need to get into with this, and that I will talk about in the video for number 3, which I'm in the process of producing right now, and I should be uploading here sometime in the next hour or so. So the video for module 3 will be up today, and then I'll get the quiz done this afternoon, and then I'll start working on module 4. It's a race to the finish, guys. So again, long calls, if the price goes up, the values of these options will go up. If the price goes down, the values of these options will go down. Okay, that makes sense. Now, if we are short calls, if the price goes up, if the price of the underlying goes up, then the call values will still go up. However, that's going to mean the position value goes down to us, because that it's going to make it more expensive for us to buy the position back. Okay, so that may not make sense until you listen to that a few times. So if you have to, rewind, replay this again. Now, if we have long puts, now we're going to focus on the right side of things. If we have long puts, we're going to be over here. Okay, so those are long puts. If the price goes up, if the underlying price goes up, these long put values will go down. If the underlying price goes down, the put values go up. And then if we flip this around and go short puts, the price will go, if the price goes up, then the put values will go down and our value of the position will go up. Because what we sold for maybe like $500, we can buy back now. Since the put values dropped, we can buy them back for a cheaper price, and the value goes up of us, the short put seller. I know it's confusing, and sometimes the verbiage doesn't make sense until you draw this out and go through these from a buying and selling perspective. And if you have to, go ahead and open up a testnet account on Deribit and get some experience with this. Okay, so let's talk about changes with option value with changes in time. Again, if there's any questions, go ahead and stick your boot in the door and let me know what I can help with. Time passage is linear. However, the option value with respect to time is not linear. It accelerates as the time approaches expiration. So you'll get used to seeing this chart. Time passage is linear. So if this is time, And if this is the value of that option, it's going to start off with very slight decay. And then as it gets closer and closer to expiration, boom, it's just going to drop like a stone. So this is expiry right there, that date. And actually some of the options are expiring today with Deribit. We have this, the 2 August options are expiring today. And we can look at that in just a minute. In fact, you know what I'd like to do is I'm going to just bring down the chain right now with this instead of going over a fixed example. So, oh, that didn't work. Let's try that again. There we go. Okay, so so I can't even trade the 2 August anymore because they must have expired. So let's look at the 9 August. The 9 August, and we'll compare that versus the 16 August. So what I want you to look at is the $10,000 call option. The $10,000 call option, which is slightly in the money because the price is $10,585, right? And that one is going for, let's just say $600. The 9 August call option at 10,000 is going for, about, let's say $900. It's going for $900. That one is right here, about $900. That's the 9th of August. That's next week. Now, what's happening 2 weeks from now? Here's the 16th of August. Let's look at that same option. The 16th of August, instead of $900, this one is going to be somewhere on the order of $1,110, $1,120 to buy this option. Okay, what's the difference in there? That's that time value decay. Remember? That's that time value decay that we talked about where it's like dropping off like that. We're getting this thing between the 16th and then here's the 9th. And then this will be expiration coming up soon, right? So we've got just a little bit left of that time value. And that's why we're seeing these at 10,000. That's the 16th is setting up right there. And then if we go back to the 9th of August, that's a $900 option. So you can start to see that time value decay in process right now. Right? Does that make sense? And then we can look at this with the puts. The puts will be the exact same thing. For this, we can see that the options, let's look at the 10,500. No, let's just look at the 10,000 as well. So this one is probably somewhere for 9th of August is something like $275. And then if we look at that same put option for the 16th of August is going to be closer to $470, $480 at that $10,000 strike, right? So keep looking at this. Look as much as you can on the option chain. Learn to work with the option chain. Learn to work with that option chain so that you understand what's happening with the pricing of these, okay? Let's move that out of the way. We're not going to go through the same ones here. If you sell to open an option, the passage of time is your friend. Can you see that? Can you see how that option basically expires or bleeds that option? It decays that time value component over the course of a week. The passage of time is your friend. If you're long an option, the passage is not your friend because you're holding that melting ice cube and you're trying to find that drink that it belongs in. You hope that the move that you're looking to make occurs within the span of expiration. So, Lexus, what is your goal for price? I'm not sure how to frame that question in. What is your goal for price? It depends on what we want to do, right? So if we're long a call option, we want the price to go higher. If we're short a put option, we want the price to go higher. If we are short a call option, we want the price to go lower. If we are long a put option, we want the price to go lower. So that's always your goal. So that's where you're going to use to set up the trade, depending on what it is that you want to accomplish. So if you're selling a put, generally you want to be selling a put at a level where you think it's going to bounce or it has bounced. So now let's switch to, we talked about price movement. We talked about time value decay. Let's talk about implied volatility, which probably is the most difficult concept for you to understand. Again, think of that balloon. Think of that balloon. Depends on whether you want that balloon to inflate or deflate after you've entered the position. Okay, so what are some reasons for implied volatility to rise? Remember, implied volatility means it hasn't happened yet. Implied volatility means that it hasn't happened yet. It's basically being priced into, it's a forward forecast of option prices, believe it or not. Believe it or not, it's a forward forecast of option prices. And those that can understand what the market makers and the participants of this market are saying can use that to your advantage. Okay, so what are some reasons why the forward volatility might be projected to rise? Well, a lot of times it's a big event that's coming up. Now, in the equity markets, these are they're quite easy to predict because they're scheduled. Every 6 weeks, the Federal Open Market Committee, the FOMC, gets together and talks about interest rates. We just had a meeting this week about that, and they cut the rates a quarter point. Right? So the implied volatility was rising up into that event because they were like, oh, something might happen, and we don't know what it is, but something might happen. Now, what are some reasons why we could think of this would happen in crypto? Maybe a halvening event. It could be. Some scary event like the price crashing. If there is a scary event like the price crashing, then implied volatility will rise. The rise in implied volatility is, and I hate to define something with its own word, but it's implying, it's inferring that volatility will be higher in the future if there is a rise. And this pumps up that time value of an option like blowing up a balloon. So these are some of the reasons. I mean, these are not the only reasons, but it could be anything. Like if you think about stocks, they report earnings 4 times a year. Those are called the quarterly earnings. The implied volatility will rise up until the actual event. And then if there's no surprises, then the implied volatility drops like you just popped a balloon. Almost like you popped a balloon. It just disappears from there. Now, what are some reasons for implied volatility to fall? A lot of this is around the term certainty. If you ever hear me use the term certainty, this is really what markets want. They crave certainty. So a big event has passed and nothing unexpected occurred. The participants stepped up to the first tee in the golf course, and instead of putting it into the woods, they put it right down the middle of the fairway. Just what everybody was hoping for. Everybody breathes a big sigh of relief and says, oh, okay, certainty has come back. Can volatility be correlated with volume? To some degree, yes. What you will typically see is that on big sell-offs, you'll see much higher volume. On big sell-offs, you'll see much higher volume. Typically on rallies, you see declining volume unless you get to the very end. And then when you see higher volume during price peaks, this is where you get into a runaway market, and that leads to volatility. So yeah, there is a little bit of correlation to volatility there. So reasons for implied volatility to fall: a big event has passed, a bounce from a crash. So if you think about this, if you have the price crashes and then it bounces back up again. So that balloon is great big here, and then it's a little tiny balloon right there. All that implied volatility is just like bled out of that balloon. So what was big down here is now very small. So a bounce from a crash is where it's also called a crush. A persistent rally will also crush implied volatility. We'll just take the life out of it. And this fall in implied volatility is implying or inferring that volatility will be lower in the future. And so you'll see this with quiet and trending rallies, markets that just sort of quietly do this sort of thing, just chunking along like this. You will see implied volatility will be very, very low. People are very complacent during an uptrend. People are very fearful during a downtrend. So when this crashes or corrects, you'll see implied volatility do the exact opposite of that. You'll see it spike. So maybe the gears are starting to turn for you in terms of the edge that you can create. So this destroys the time value of an option, just like the letting the air out of a balloon when it crushes like that. Okay, so long calls with IV rising and falling. So if you're trading a long call, this is a big time headwind. If you enter a long call option right down here, when implied volatility is peaking, that implied volatility will come out of it. And even though you've got the price movement right, your call option may not be gaining any value at all. And you're going to be shocked. This is the biggest rookie mistake that you can make with options, is to look for a call option entry at the bottom of a sell-off, because you'll get that crush. It's almost like a headwind going against you, right? So it's like if you've ever been sailing, you're sailing along and all of a sudden you hit a headwind and you start going backwards, right? So until you tack with the wind, you can actually start being blown backwards, even though everything, maybe even the water is currents going in that direction. So that's a long call with IV falling. Now, IV rising, a long call, you rarely get that scenario. You rarely get, usually with IV rising is you bought a long call and the IV is rising, which means the price is dropping from you, and you're not very happy with that. So this is why long calls can be a real problem with implied volatility. You've got to be trading a long call when it's very, very quiet. Now let's get into short calls. If we sell a call, we want implied volatility to be falling. Anytime you sell an option, you want implied volatility to be dying after that. You don't want to be selling an option and then have it rising after that. You will be unhappy with that. So IV rising, not good. So this is kind of an interesting thing. If you sell a short call, that's a bearish trade, but the implied volatility will be rising. This is almost going to be, once again, you get into this sort of situation where you've got it right in terms of the price going down, but the implied volatility is rising. So it's kind of working against that. So you have to be careful with this. Let's go to a long put. Here's a really interesting scenario. How is a premium defined for options? I define that in module 2 of the course. It's time value versus intrinsic value. You can determine what the implied volatility. Sometimes you can see what the implied volatility is depending on the broker. It's not tracked right now, which is a problem. It's difficult to determine the trend for those, but you can see what the implied volatility is and factor that in. That goes into the Black-Scholes theorem. So long puts, this is actually a scenario where you can have a lot of things going in your favor. A long put, with the price falling, will actually accelerate in value because the implied volatility will be rising. So this is one of those scenarios. There's two scenarios out there, either a short put after a pullback or a long put at the very top of a market move. You can see a dramatic acceleration in value to these, where you've actually got two of these factors working with each other. So not only a long put, if the price is falling, it gains value, but if the price is falling, implied volatility is rising, and it's really accelerating in value. It's dramatic. And this is why a lot of option traders that are professionals are almost constantly bearish all the time, even though the markets are going higher. This is because this gives them an edge, and they can sell against this edge. Okay, long puts with the IV falling, that means generally you've got a rally and you're not going to be happy about that. Okay, short puts with IV rising, that means that if you sell a put and the implied volatility is rising, that means that you've sold it and the price is continuing to attack your strike. You're going to be unhappy with this scenario. But with the implied volatility falling, this is where you'll see both of those factors going in your favor. Not only the bullish trade gaining value as the price goes up, but the implied volatility will be falling as the price goes back up again. And this is what I'm seeing on the short put option that I have right now with Deribit, because it's happy because the price is going up, implied volatility is falling. Okay, that is my material for today. I'd love to take your questions beyond those that have already been asked, or if there need further clarification on that. Again, what we're going to be doing in the masterclass is I'm going over sort of the ABCs, the options 101 sort of thing, like why trade an option? Why would I need something like that? And hopefully show you the different applications that you can do, which you can't do with a spot currency. You can't do these with futures. You can only do these with options. And for the very first time, we're actually getting some decent semi-liquid options, and I believe that that will be much, much better by the end of this year. I think some of the bigger players will get involved in this. And right now, it's all about Bitcoin and a little bit about Ethereum. So don't be afraid to specialize in one coin for that. And so what I'm showing you in this program is after we show you how options work, it will become clear that there are a couple of applications which really put the odds in your favor. And we're going to have you do those. And that is through the short put option, which is called the cash secured put trade, where you become the insurance company. And then on top of that, once you start to acquire more and more BTC, where you've got some real estate that you can afford to rent out, then you can become a landlord on top of that and multiply your return. So it's really interesting stuff. These are strategies that have been around for a dog's age in the equities market, and you're going to be some of the first people that understand how to use them in the crypto option space. Certainly, there's nothing else out there right now that I'm not seeing anybody else out there teaching options to crypto traders right now. So this is the sort of stuff that allowed me to quit my job, was learning how to trade options. So it takes a little bit of application. It takes a little bit of diligence to understand how the edges can multiply. But once you get those, and also once you stack your probabilities on top of that with a little bit better chart reading, right? Okay, so to sell put, what would be the best time to enter? Can you show on the chart? Certainly. All right, so let me bring my chart over to here. Okay, what you don't want to do when you sell puts is you don't want to do it during times like this. You don't want to do it during times like this. I mean, you could certainly sell puts here, but then in a primary bear market, it is bad practice to do that. In a primary bear market, you don't want to be selling puts because you only want to sell puts against something that you want to accumulate. Now, if you want to accumulate, if you want to use selling puts as a different way to dollar cost average, knock yourself out. Okay, I don't like doing it that way, but that's just me. I'd rather sell puts on something in a primary uptrend. Is it worth trading Ethereum up? I'll get into that yet. I actually haven't looked at those yet, Tig. That's a great question. It probably don't have the same liquidity. It's probably going to be more problematic, but the margin relief is significant. So you don't want to be trading short puts in a primary bear market because you don't know where the bottom is. But once we start to trend to the upside, then you want to aggressively sell into pullbacks. Like here is a great pullback to sell into. You probably could have gotten strikes down here at 6,000, 5,500, sold significantly premium at those levels. Any pullback like this is going to be good. I sold down in this area when we started to get positive divergence showing up on the market. I sold down at the $9,000 strike for the end of this month. And right now, this is where you get that multiplication from. Not only is the price going higher, but the implied volatility after peaking out probably here has started to do, this kind of thing. It started to come back down. So one thing you don't want to do, and so this goes back to Lexus's question, one thing you don't want to do is you don't want to sell puts when the market is ripping to the upside. You don't want to be chasing after a trade. You want to be taking that pullback, and this is what's going to be difficult for you until you do this and you survive a couple of these, is do you want to sell into the fear? Because this will get you a much better price point. This will get you much better premium because the implied volatility gets jacked up. It makes the trade much, much better. And this is what's been by far my most successful strategy over the years, is just this notion of selling puts into pullbacks on something that's trading and trending to the upside. Okay. So these would be good times to do it. So that's a good time to do it. This would be a good time to do it. This isn't a bad time to do it here. This is a good time to do it. This would be a good time to do. These are always obvious after the fact, right? So at some point when you have the market coming down here, and you could also do this based on the fractals, right? So when you have the energy dissipated to the downside is a good time to do this. So this is where I will look for, and we're not always going to get these levels here. This is not going to necessarily be kind to us. So these down here, and this is what happens in primary bulls. You don't necessarily get an exhaustion signal on the daily chart, do you? Okay, but you may get an exhaustion signal on the 5-hour chart. So you may get exhaustion right there, 5-hour chart. You may get an exhaustion on the 5-hour chart down here. It's pretty close, right? This is where you have to look at using different methods to be able to time these trades. And we'll go over that in the latter modules of this course. Okay, I think we are clear of questions. If there is anybody else that comes up with something, please let me know. It's in the Discord community in Omnia, or send me an email, support@ReadySetCrypto. So KL's got a question. Is it a good time to sell a put for Bitcoin today? I would say no. You don't want to really be chasing after this. So right now at 10,500, if we sold a put at 10,500, okay, let's bring down. I mean, you can kind of answer the question if you go out for like a month from now, okay, so 30 August, if you say to yourself, okay, where could I sell a put? Could I still sell a put at the $9,000 level? So if you think that that's still good, yeah, you can still trade that, but you're not going to have nearly as much edge as if you sold it with the price coming down. You probably could have sold that for closer to 800 for something like that, right? So you give up significant edge waiting for some kind of confirmation with the price going to the upside, because not only is the price running away from it, implied volatility is dropping like a stone. You give up a lot of edge, but you give yourself a little bit more, I guess, peace of mind. But sooner or later, you'll have to learn to sell into the fear. You got to learn to sell into the fear. And this is not only to the downside. When you sell puts, you want to be selling them into that screaming fear with a big volume spike. That's the perfect time to do it. But also when price is going berserk to the upside, that's when you want to be turning around and becoming a landlord and selling calls above the current price. Those are the best times to sell calls. This is the best time to sell puts. Okay? Everybody good? All right. Again, if there's, I got to run and finish this this module 3. I'm starting to get some people grumbling at me, so I got to get some of these things done. And I'll get more of this done over the weekend as well too, guys. So if anything doesn't make sense, or if you're still confused by something, reach out to me. Otherwise, you guys have yourself a good weekend, and I will see you soon online. You guys take care. And let's see, where are we here? All right, there we are. Okay, so you guys take care. Have a great weekend, and I will see you guys soon.